Good morning, traders. This is your Forex market commentary brought to you by REAL ECN. Today's commentary, we will highlight the euro-dollar market. A dramatic correction observed in the euro-dollar market during the last two trading sessions of last week was sparked by a dovish ECB rhetorical threatening to implement further easing policy as the banks see the elevated strength of the euro becoming a serious concern. This week is packed full of Tier 1 economic report both out from the Eurozone as well as the US, allowing the market to set trend expectation for the pair moving forward. First, in line with this commentary, we will touch base on the euro-dollar market on the 1 hour time interval chart on the technical front. Once again, the euro-dollar market topped out north of the 1.3950 level during last Thursday trading session. The build-up in selling pressure was triggered by a risk event which presented itself as the German industrial production print, which contracted when expectation forecast an expansion. Reinforcing the selling pressure was a pessimistic ECB outlook on the Eurozone economy. The selling pressure only came into exhaustion once the price action tested the 1.3750 support level. The last component underlying this dramatic euro sell-off can be linked to traders' profit-taking actions. When the euro-dollar market price action peaked at the 1.3900 level, euro short interest spiked at 6 outstanding net short positions for every 1 long euro position taken up by retail traders against the greenback. Currently, this extreme sentiment has leveled off, which is reflective in the short position that is currently sitting at 3 net euro short positions for every 1 long position. Analysts would suggest taking the contrarian outlook to this crowd sentiment extreme and in favor of further euro strengthening. However, the near-term technical outlook may favor further correction in the pair until the shift in this bearish euro fundamental materialize. Analysis in a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend long positions on the greenback. The hourly chart showed that the single currency opened today's Sydney's trading session inching closer to its established short-term Fibonacci resistance set at 1.3764, while the Fibonacci support level is at 1.3750. Last week's euro correction had forced the euro-dollar cross to break below the 200-day simple moving average and continue to trade below the 200 days. The long-term outlook on the single currency has been downgraded to bearish if the trend continued to trade below the 200 days. This trend action holds great significance as 200 days simple moving average contain more or less of 1 year's worth of trading data and its forecast long-term market sentiment. This bullish long-term outlook on the euro-dollar pair is not shared by its short-term moving average counterparts, as the euro-dollar pair opened today's Sydney trading session above the 5 and 10 but below the 20 and 30-day simple moving average. Collectively, this is indicative of a hold recommendation on the technical front. Moving on to this week's risk event, it is important to highlight these risk events because they play a profound role in moving and giving direction and clarity in the euro-dollar market. On Tuesday, we have the Eurozone ZEW economic sentiment forecast at 63.5. Also on Tuesday, we have the German ZEW economic sentiment forecast at 41.0. Over in the United States, we have the US core retail sale month-on-month forecast to expand at 0.6%, while US retail sale month-on-month forecast to expand at 0.4%. On Wednesday, we have the Eurozone industrial production month-on-month forecast to contract by 0.3%, while the US core PPI month-on-month forecast to expand by 0.2%. Also, we have the US PPI month-on-month forecast to expand at 0.2% as well. On Thursday, we have the German GDP quarter-on-quarter forecast to expand by 0.7%, as well as the French GDP quarter-on-quarter forecast to expand by 0.4%. Also, we have the Eurozone core CPI year-on-year forecast to expand by 0.7%. This is CPI number for the Eurozone is very important because this is what the ECB has been stressing about, that the elevated level of the Eurozone can hinder the CPI growth. If this can beat expectation, this can shift expectation that the ECB may scale back its dovish rhetorical. Also, we have the Eurozone CPI year-on-year forecast to expand by 0.7%. As well, we have the Eurozone GDP year-on-year forecast to expand by 1.1%, with Eurozone GDP quarter-on-quarter expected to forecast by 0.4%. Moving over to the US, on Thursday, we had the Philadelphia Fed Manufacturing Index forecast to expand by 14.0. Lastly, wrapping up this week trading session, we have the US building permits forecast at 1.015 million, while the Michigan consumer expectations forecast is 75.0. Now, moving on to the fundamental aspect of the euro-dollar market. Without a doubt, last week's ECB press conference was a major trigger in the euro-dollar market correction. Heading into the press conference, the pair briefly closed a few pips above the 1.400 level as the market expected the ECB to remain committed to the continuity of its current monetary policy. However, it was during Draghi's press conference that the volatility-inducing wildcard came into play. Mario Draghi revealed to the press that he's willing to instigate another stimulus program against the backdrop of other central banks that is either entering its first cycle of tightening or scaling back the QE program. The next ECB meeting will be held on June the 5th. By then, the market will be able to price in whether the ECB will cut their benchmark rate further or pursue a negative deposit rate policy. In addition to this, Draghi also elevated his concern over the strength of the euro exchange rate, which posed a threat to inflation growth. The spotlight is now on the ECB credibility as the market awaits the next ECB meeting, by which these threat of further easing policy should be backed up by a concrete policy. Failure to do so would damage the ECB credibility in the eyes of the market, and this could be the catalyst that revives the euro bullish momentum. Over in the United States, the continuing suppression on the U.S. Treasury yield curve inversely capped the greenback bullish momentum. The greenback only rallied against the euro on a shift in Eurozone fundamental outlook. Last week, Janet Yellen's testimony to the Budget Senate Committee did very little to provide clarity on the monetary policy doctrine. And this is very reflective in the weak greenback momentum across the broader FX market. One revelation during the testimony was that Fed chairwoman would not be moving the inflation target as part of her 2% forward guidance mandate. In addition to that, the U.S. benchmark rate would not rise until the Fed believed that the U.S. recovery story is robust. I want to thank all our listeners for spending their time with us, and have a successful trading session, everybody.